so short-term focus, which can be essentially gambling. So actually, here's the conclusion. I'm going to step forward, try to wrap this up shortly. The new normal, maybe, but this slide, we blogged about this in the past from Charles Schwab & Co. shows that your unemployment rate, even in the periods where you think things are the most dire and it can't get better from here, in the 70s or in the 80s, it actually, once the recession is officially over, as determined by the National Bureau of Economic Research, the rate of unemployment tends to move very quickly in the other direction, and some market research analysts expect that, okay, it's likely the recession officially ended in the summer of '08. So we'll see what happens. There's always a lag there, but it does seem that, well, maybe this new normal could be inaccurate, and it could be a pleasant surprise. We hope. Now, what's a strategy that works in all markets? This is our strategy. Think and invest like an owner with a long-term view. And there are, so short-term is uncertain, but the long-term is highly correlated to earnings power. And when evaluating businesses, we can ask these basic questions, which will help you ascertain whether or not it may be a good purchase. And does the business have a strong financial position? That is the balance sheet strong? Can they survive tough times? What would happen if the business went away tomorrow? Would anyone care? If they wouldn't care, then it may be in a weak competitive position. If there's huge concern, if people would throw their arms up and say, look, you can't go away, we need you, we depend on you, then you know there's probably strong competitive market position. Is management capable and motivated? Is your disclosure full and adequate? Will the business be bigger, better, stronger in 5 years? And can the business be acquired with a margin of safety? And this point is extremely important. So we'll emphasize that price is extremely important, and we actually agree with and kind of like this saying that Bruce Berkowitz of Fairholme Funds relayed on a recent Wealth Track episode. It says, investing is all about what you pay and what you get. And that's really a variation of what Warren Buffett and Ben Graham speak about when price is value. It's kind of all on how you evaluate, how you assess the situation. But price is extremely important. So the last bit here, and Ben Graham says, look, even in periods where the market is relatively sideways, there still can be excellent buying opportunities because the market will fluctuate. You will have volatility. So volatility can be your friend, and certain issues, if you buy them at the right price, are likely to return to more normalized levels at some point, generally within a period that may be shorter than you might expect. So where are some of the areas of opportunity that we see where we have ownership positions and where maybe we've been buying more shares? Consumer discretionary. We mentioned earlier how your Whole Foods, your Williams-Sonoma, Tiffany, all these have tripled or quadrupled. So, okay, well, maybe there are some areas that haven't, and we are aware of those. Another area is container shipping. There's a huge cloud of ships, easy money times, spread throughout the whole world, unfortunately, and too many ships are ordered, and those ships are ordered on a long-term basis, so they ordered 2 or 3 years ago, and in many cases they're just now coming to market when the economy is weak, so there's not enough demand. But that creates an opportunity for those willing to look out a little bit longer and ride through the storm. Lastly, personal services, and in this case it's Weight Watchers, which we've also blogged about before. So briefly, the first one is 1-800-Flowers, and we may share more soon on the blog about this one, but this is a business that's a portfolio of gift brands. Online Flowers is about half their business, and they've actually done a great job of diversifying into other areas which are more stable, such as chocolates and cookies, and it is actually quite good. If one of their chocolate businesses, candy businesses, called Fannie Mae, and we grew up in California on See's candy, which is excellent, but we have to say that the Fannie Mae quality is quite good, and if you ask some folks in the Midwest, they'll say, hey, actually, we like Fannie Mae better than See's. The bottom line is that, look, internet we think is going to be around. It's not going to go away. We think more people will continue to use e-commerce, and those companies that have established franchises, brands on the web, will be around. And the beauty of 1-800-Flowers is that current buyers at the current level in the mid-$2 range can buy the business at an equivalent of a 15% free cash flow yield, which we like. Actually, between 15 and 20%, depending upon what cash they generate. But we expect, assuming the economy continues to kind of chug along as it is today, we don't think that There's a whole lot of downside risk at current levels. They're using excess cash to repay debt, and at some point can probably repurchase shares, buy other companies to add to their portfolio brands, and potentially pay a dividend. The next one is Seaspan Corporation, and this is a container shipping company. It's really set up as, like a real estate investment trust, a very stable business with a diverse book of customers, with stable long-term leases in place. And the stock used to trade between 20 and 30, if you look at the chart here, and we don't base our decisions based on the chart, but if you think about the earnings power, so this company has a built-in growth that is occurring as new ships are delivered that have already been contracted for, and generally these are non-cancelable. So the ships to be delivered are happening, and it's adding to their revenue, to their cash flow, and the cash flow that can be distributed in the form of a dividend. Their dividend was cut, and there is a slight financing need that they have to finance their new builds, but the distributable cash flow, from how we look at it, could be as high as $3 or more as you look out into 2012. And so you can buy the stock today in the low teens or around 10 or 11, and you're paying 3 or 4 times distributable cash flow a few years out. And you think about if, well, realistically, at some point the economy does improve, we'll need more ships, we'll need more container ships. So if that doesn't happen, then, well, it's a risk factor. We don't know for sure, but more likely than not, we think that growth will continue. You'll need more ships, and the market at some point will award a higher multiple to Seaspan. So we're willing to buy it, collect a small dividend today in anticipation of a higher dividend in the out years. And lastly, Weight Watchers. We'll keep this very brief. Most of you may know Weight Watchers. It's been around since the 1960s. It's a tremendous franchise with great margins, excellent returns on capital, an attractive dividend, which we think could get better as they continue to use excess cash to repay debt moving forward. So that's a brief look. The slides will be posted along with this video. Feel free to download them. And again, keep in mind risk factors, invest at your own risk. And thank you for following the blog. We now get maybe 1,000 unique visitors per month, with about 40–50% of those repeat. So appreciate you reading and tuning in. Thanks again for your time.